Every trader uses a platform, and most traders never really think about why they use the one they do. They sign up with a broker, the broker handed them a platform, they open a chart and started trading, and that's how it usually goes. But the platform you use is not a neutral decision. It shapes how you see price. It shapes how you interact with the market. It shapes the amount of friction between your thinking and your execution. And for traders working on longer time frames, weekly charts for example, that relationship between the trader and the platform matters more than most people realize. In this video, I'm going to walk you through what trading platforms actually are, why they exist the way they do, how experienced traders think about choosing one, where common thinking about platforms tends to break down, and where platforms fit and don't fit in a position trading approach. This is not a comparison shopping video. I'm not going to tell you which platform to download. What I want to do is give you a clear mental model so that when you evaluate your own setup, you're thinking about it the right way. A trading platform is software. That's the simple answer. More specifically, it's the interface that sits between you and the Forex market. It connects you to your broker, it displays you live price data, it lets you place orders, it shows you your account balance, open positions, and margin levels. And every platform does those things. And that part is not where the differences are. Where platforms differ is in everything around that core function. The quality of the charting tools, the clarity of the interface, the depth of what you can see in terms of price and order flow, the time frames available. How stable is the software, whether it runs in a browser or requires a download, how well it works across devices. Now, here's what a trading platform is not. It's not a strategy, it's not an edge, and it's not a substitute for understanding the market. I want to be direct about that because there's a tendency, especially early on, to believe that a better platform will make you a better trader, and that if you just had cleaner charts or a sleeker interface, something would click. But that's not how it works. A platform is a tool. The best tools reduce friction. They make it easier to do the thing you already know how to do. They don't teach you the thing, they don't do it for you. And what you're looking for in a platform is clarity, reliability, and alignment with how you actually trade. Retail Forex trading became widely accessible in the early 2000s. And before that, the currency markets were largely the domain of banks, institutions, and large fund operators. When retail access opened up, brokers needed a way to connect individual traders to those markets, and the platform became that connection point. MetaTrader 4, or MT4, was launched in 2005, and it solved real problems. It provided retail traders with a stable, consistent environment to execute trades and conduct basic analysis. And because it was widely adopted by brokers, it became the standard almost by default. That's not because it was the best possible software. It was because it was available, it worked, and the ecosystem around it, the indicators, the automated systems, the broker integrations, they all grew around it over time. MT5 came later as an attempt to expand what MT4 could do. More time frames, more asset classes, better testing tools for automated strategies. TradingView took a different approach entirely. It wasn't built around execution. It was built around analysis. It became a cloud-based charting environment with a community-driven script ecosystem and a clean, modern interface that works across devices. cTrader came from a different set of priorities: execution transparency and institutional-style order handling for retail traders who care deeply about how their orders are being processed. Now, each of these platforms exists because a different group of traders had a different primary need. And understanding why they were built tells you a lot about why they're the right choice. When someone who's been trading for a long time thinks about their platform, they're not asking what's the most popular option. They're asking a narrower question. Does this tool support the way I actually work? For a position trader, someone operating on weekly charts, the relevant question looks like this. Can I see price clearly across higher time frames without the interface fighting me? Can I draw and annotate cleanly? Does this platform make it easy to step back and look at the big picture? Or does its design push me towards short-term noise? That's why TradingView tends to resonate with position traders. It was designated with analysis at the center. The charting is clean, the multi-time frame workflow is intuitive, and because it's browser-based, it's consistent across devices. But an experienced trader also knows that a platform and a broker are not the same thing. You can analyze on TradingView and execute through a separate broker-connected platform. Many traders do exactly that. The two functions, analysis and execution, don't have to live in the same place. What experienced traders avoid is choosing a platform based on what other people use, or switching platforms frequently because something newer looks appealing. Consistency matters. Every time you change your environment, you introduce a small tax on your decision making. You're relearning the layout. You're rebuilding your visual familiarity with how price looks on that interface. The cost is real, even if it's hard to quantify. The goal is to find a platform that fits your process and then leave it alone. The most common mistake I see in how traders think about platforms is conflating the quality of the tool with the quality of the trading. A more complex platform does not produce better decisions. More indicators do not produce better analysis. A faster execution engine does not help a trader who holds positions for days or weeks. These things are disconnected, but the way platforms are marketed and the way traders talk about them tends to blur that. There's also a tendency to treat platform switching as a form of progress. If results aren't where you want them, change the platform feels like doing something. It creates a sensation of taking action. But if the underlying decision-making hasn't changed, a change in platform doesn't change the outcomes. Another breakdown point is the assumption that a platform's features represent a trading approach. Because MT4 has an automated strategy library, people automatically assume automation is a valid shortcut to consistency. Because TradingView has a large community, people assume popularity validates the tools being shared. Neither of those assumptions holds up well under scrutiny. The deeper issue is that many traders don't have a clear definition of what they need from a platform before they start evaluating one. They are comparing features without a framework for which features matter. When you know what your process is, what time frames you work on, how you analyze price, what your execution workflow looks like, platform evaluation becomes a much simpler exercise. Most of the options fall away quickly. In a position trading approach, the platform plays a specific limited role. It provides the environment for analysis. It displays price across the time frames that matter, primarily the daily and weekly charts, and it gives you a clean space to identify context, mark key levels, and monitor open positions over time. That's the core of what the platform needs to do. What it does not need to do is support rapid execution, provide real-time level 2 data, run high-frequency automated strategies, or deliver news alerts and social sentiment feeds. Those features are relevant to other approaches. They're noise for a position trader. TradingView fits well here because it doesn't push you toward those things. Its defaults are clean, its charting is built for analysis, not for speed. Where platforms don't fit, and where I think it's worth being honest, is as a substitute for process. I've seen traders spend more time customizing their charts than thinking about the way they trade, which makes no sense. That's an inversion of priorities. The platform should be invisible when you're doing good work. You shouldn't be thinking about it. You should be thinking about price, about context, about what the market is communicating. If you're constantly thinking about your platform, adjusting it, questioning it, comparing it to alternatives, that's usually a signal that something else in your process needs attention. The right platform is the one you've stopped thinking about. The way I think about a trading platform is simple. It's the space where analysis happens. It should be stable, clear, and aligned with the time frame you're working on. Everything beyond that is optional. Platform choice matters, but it matters a lot less than traders tend to believe. What matters more is whether your analysis process is sound, whether your risk framework is consistent, and whether you're approaching the market with patience and clarity. Those things don't come from the platform. They come from the trader. If you want the complete framework for everything covered in this video, I've written a detailed guide on positionforex.com titled Trading Platforms, Which is Best for Your Trading. It walks through every major platform in depth, what it was built for, where it performs well, and where it falls short. So you can make a clear-headed decision based on how you actually trade. And you can find that article in the link in the description. And until next time, best to your trading.